All right, let's make sure this mic is on. Testing, testing. All right, guys. Good morning. Good morning. Welcome aboard to the Morning Note. My name is Carlos Garcia, founder and CEO of GAR Capital. It is Monday, March 13th, 2023. Thank you so much for taking the time out of your day to join me this morning and every morning at 9 a.m. Eastern Standard Time. Let's go ahead and get started. A lot to cover. Obviously, we had some weekend headlines, so let me go ahead and start with the opening monologue of what I see in the market. So let's go ahead and start with SVB, Silicon Valley Bank. Good morning, Zoom Balloon. Glad to have you on board. So let's go ahead and get with it. So overnight, the FDIC and the Fed had a coordinated effort with the government to ensure all uninsured FDIC-insured deposits. Keep in mind, the FDIC is the Federal Depositor Insurance Corporation. It's a corporation, and they collect premiums from banks that the banks pay in order to protect depositors' insurance. This was created after the Great Depression. Before the Great Depression, before the 1930s, if you had money in a bank, it was not protected. It was protected by the bank in a sense. Like as long as the bank remained solvent, your deposits were fine. So you're not only a depositor, almost an investor in the bank. So when we had bank runs in the Great Depression, when banks started failing, there was no protection for depositors. I'm sure you've heard of this, I guess, fun example where people keep their money under the mattress. That's where that came from, was the Great Depression, where people felt like there was no confidence in the banking system. They would take their money and then they would hide it somewhere under their mattress. Well, times have changed, obviously. We actually had our FDIC increased limits in 2008. I used to work at Citibank in the banking sector, and I had to learn about FDIC. So what's interesting about FDIC, and a lot of people don't understand, is that it's FDIC $250,000 per account per signer. So again, let's say you're watching the Morning Note and you have millions of dollars in the bank at JP Morgan, let's just say. You could literally break up that money, 250K, 250K, 250K. What you do is that you have one as you by yourself, one in trust of your mother, your son or your daughter, and then another one a signer with your son or your daughter, another one with a signer with your wife or husband, whoever. And then you could just keep doing that with signers. You would stagger the protection based on the amount of signers that you have. So again, you can have an account with 250 by yourself. You can have an account in trust for your son for 250,000. That's insured. You can have another CD that's with your wife, 250,000. That's insured. And you can go on and so forth. We would do that for clients all the time to make sure they were protected. But again, like I always said to them, that if Citibank failed, there'd be bigger problems than their CD. Obviously, I was joking. But again, the FDIC insurance limits, again, if you fall over those categories, that's something that a lot of people were concerned about, because if the Fed didn't, or the FDIC did not cover these $250,000 deposits or more, the uninsured ones like SVB, then you would get a bank run where everyone is looking for different banks to deposit their $250,000. Now you're probably thinking to yourself, oh, well, who cares about millionaires and billionaires? Well, a lot of business owners have funds in their bank. So if they didn't have that protection, they would have to move around that money, get below 250, or pull it less than 250 in Bank A, Bank B, Bank C, Bank D, Bank E. So again, it would be a complete mess of the banking system, since money would be coming out and it would just be money going back and forth. So it seems that SVB was protected in terms of the depositors. The shareholders and bondholders will not. So not very similar to 2008, because 2008, I mean, at the end of the day, that bank was acquired. So Bear Stearns being the first one. Lehman was the one that went bankrupt. So again, a little different approach. People were saying that it was backwards. No, Bear Stearns were bought out for like $2 a share, and then Lehman Brothers collapsed. SVB, in a sense, collapsed like a Lehman, but the best comparison would be Washington Mutual. And Washington Mutual, again, was bought out by JP Morgan, and their depositors were protected. So yeah, it seemed like that was something that had to be done. Now we're getting banks falling. So let's go over the technicals rather quickly in terms of the banking system. And in terms of the FDIC and everything like that, in my opinion, again, reading as much as I could this weekend, the banking system seems rather solvent. We have a lot of liquidity. It's not like you can't borrow money. You can. So again, you had SVB, which was a niche bank, again, just for venture capitalists, and then they invested in longer term treasuries. The risk with that is higher interest rates rather quickly from the Fed. Fed hiking makes those bonds less valuable. Again, mark to market, right? The problem with those bonds is that if those bonds fall and they need capital, they would need to sell those bonds, right? Let's say it was $1 billion, but they would sell it at a loss. Again, they couldn't hold that in their balance sheet. The deposit base was strong, according to Forbes and all of these other banks that gave it good credit ratings, and also labeling them as a buy. JP Morgan, Citibank have all said that. So again, they're obviously to the point where they just got hit with their investments, but their deposit base is solid. So I would assume some bank out there would want to buy those deposits. Banks are like vultures. They just circle around waiting for the dead and to eat them up. So going to the technicals here, we talked about this on Friday's recap video. We got as high as the 200-day moving average and the 100-day overnight on the daily chart. So we were at 39.50. So here was my kind of view moving forward, or in terms of this weekend. I expected something to happen with the FDIC. I expected us to get a nice snapback rally. I talked about that on Friday. We're not pulling back. Now there's word that the Fed will be cutting rates this year. That was according to Goldman, and also will be pausing rate hikes for March. Again, that's just a prediction from Goldman. The Fed Fund futures had it as high as 50 basis point hike. Now we're at 25 basis point hike. Now there's talk of no hike. So the developments continue. We do have CPI tomorrow. So in terms of the market, this is very similar to 2020 March, where no one really knew what was happening. So you're going to get a lot of volatility right now. You're going to get just basically technical moves. So again, keep an eye on right around that 38.40, 38.30 level. Once you start breaking that alert, you're going to take a look at 3800, which was the December lows. If the 3800 level does breach, you'll probably get to 3700 and you could short. The problem is that if you don't break 3800, you can get a snapback rally back into this little green zone that I have dotted, and you'll be just chopping around for a bit. I wanted to go ahead and see if we got a pop this morning. I was expecting it overnight, and I wanted to short it. I really did. I wanted to retest the lows, which we did. So, I mean, this is where options traders are pretty much handcuffed. But good, we got a retest. We filled a gap in the morning. We had an hourly gap from the Sunday morning open. You could see it here. This is the gap I wanted to fill overnight. We filled it, 38.80. We retested. Now here's the key level for the bulls. Can they defend this level? Can the buyers defend this level? And we've seen it. We've seen turnarounds within intraday, same day. So again, we're going to see if we hold this retest. If the bulls can hold this 38.50, all with the headlines and the Fed and interest rates and the dollar. If we can hold that and we start breaking above 3,900, I think it's worth going long and then try to see if we can test that 200-day. So that's what I'm looking at least on a technical basis. Keep in mind tomorrow is CPI, Consumer Price Index, another inflationary reading. We go from one big reading of M&P now to CPI. So again, be careful with your risk today. If you don't trade today, that's probably the best thing to do. Just keep it in an observation day. Keep an eye on things. Remember, CPI is at 8:30 in the morning, so you won't have access to trade it unless you're trading futures. And futures already is wild, especially with these swings. If you're trading options, you're trading SPY, Qs, IWM, whatever, you're going to be kind of stuck at 8:30 in the morning when CPI is released and you can't do anything with your position. So again, the most important thing is to have control of your positions as you move forward. Going into weekend, we didn't have any kind of risk on the table. We had JPM runners on those 155s. JPM is red today, so luckily we caught that on Friday. Us and the team, we're probably just going to be observing today. We'll see if we get above that 39.10 level and we can play that 39.50 calls or something around those levels where we can see if we can get a quick bounce. But again, in terms of the market, we need to see if 38.30 is defended. If that does breach, then we're going to be looking to short below 3,800, and then we'll go ahead and ride the elevator down. And if not, we'll ride the escalator up. This is the beauty of day trading. It doesn't matter what side of the fence. You can trade it both ways as long as you have some kind of move. Good morning. Why do banks only back up 250K? Why not the amount they put in? Well, the 250K level was created in 2008. It used to be 100K. And the only reason that it's not insured higher, and I expect that to change relatively soon. I think there's going to be maybe, again, in my opinion, some kind of legislation or regulation passed where unlimited deposits will be covered in a bank account. I believe. I think that will be it, or the limits will be a lot higher. Whether it's 500,000 or a million, who knows? But again, that's my expectation. Does it really make a difference? Depositors are treated differently than bondholders and shareholders, Zoom Balloon. Understand that. When you're a depositor at a bank, that's not an investment. They're just holding your money so they can lend it out. But we know with modern money mechanics, that may not be true. Again, just because a bank lends out money doesn't mean they put that on the books as money lost. It's actually considered money creation. I highly recommend people read the document from the Federal Reserve called Modern Money Mechanics and how banks have to keep only 10% reserve of any loan loss. If a bank lends you 100K, again, you get 100,000, they have to put by law $10,000 into their reserves. That 90,000 is created as new money. Since you are a borrower, more than likely if you borrowed 100K from a bank, you're going to put that money into their bank account. And that's how the money grows. You're not going to blow that 100K right off the rip. And every day the banks have money in their deposits or in their computer now. It's on the safe. Again, they could take it over to the Fed for an overnight repo to gain some interest, or they can invest it in treasury bonds, MBS, or whatever they do out there in terms to make more money on that money since they do pay out interest. And that's really the only reason why the banking system is built that way, is a sense to create more money and more money to be available. Again, all recessions come with one single factor: the lack of money, lack of liquidity. That's what grinds everything to a halt. As long as money at least is readily available, that's where you're usually in a good place, because then payroll is met, people buy things, invest, yada yada. So as long as credit holds up. So again, you want to keep an eye on high yield credit, HYG, LQD, which is investment grade credit. We know that bond yields are tanking 3.485% now on a 10-year, 103.96. We're sub 104 on a dollar. And at this point, guys, again, we've talked about correlations, the dollar and the yield, that helping stocks. At this point in this environment, it's not. So having the dollar being lower or having yields being lower is not going to be a help to the market right now. The only thing that's going to help the market at this very point is confidence back in the banking system that this is contained and there's nothing more to save or nothing more to do for the Feds. And then we're now looking at CPI and see if inflation is running cooler than expected or hotter than expected, and see if they're going to raise rates next week. So, like I've said, really since January, this is not an investable market yet, guys. We're not there. If you're DCAing, no problem, dollar cost averaging. But if you're trying to look for a spot to buy stocks, it ain't here yet. You're not there. And again, there's a lot of indicators that may dictate otherwise. Oversold conditions, double a 290% decline down days on volume. Yes, but again, if you don't feel confident as of yet, and I know I don't as of this very moment, it doesn't mean that go run out and sell everything either. And again, this is a time where you need to look at your portfolio and say, hey, do I need to sell anything? Do I need some cash? That's completely fine. It's just money going back from one place to another, whether it's stock, bonds, your checking account, your savings account, your CD, it's all the same. So the point I'm trying to make in terms of the actual stock market, we don't have any clarity. Until we actually have some clarity from the Fed or from the banks showing them that they're okay, I think that's where things start bouncing a little bit. Again, include every single headline that we've had lately in the past year and a half, and this is where we are, back to end of May levels. And it's really just a chop zone, really in the big picture. But in the short picture, there's a lot of volatility. This is still a trader's market, and it has been for months. This is what you live for as a trader. You want blood on the water, you want blood on the streets, you want people panicking or people really euphoric. You want at least one extreme or the other if you're a poker player. You want to see if they're really excited or really upset, because those are opportunities. And again, chop is what kills you. We don't want chop. We want volatility. We want to make sure that we have some kind of move to play. And again, we're going to be seeing what we have moving forward. Dow's down 242, NASDAQ down 50, bouncing. S&P futures down about 29, was down a little more. So we are bouncing a little bit. I think Biden is speaking currently. All headlines, guys, if you are interested on Twitter, if you're interested, is on our Twitter page. That is free for everyone. Twitter and YouTube are always free for everybody. So again, I always tweet out headlines and really cool things to look at in terms of the market. Let's take a look at the dollar. This was from Alex. We're here on the daily chart. Again, remember we talked about that 105 level being resistance. We got as high as the 100 and we rejected. Now we're starting to get below the 20. Remember, the 20-day moving average is a very key level in terms of continuation. We have the 103.48 level, which is the 50-day. I want to keep my eye on that level. If that level does break, then we can see if we get down to 102. But at that time, if stocks are not responding, where we start getting below the 50-day on the dollar, then we'll start seeing that, hey, Now we're starting to decouple from the macro. Now it's just purely emotional. And again, those are really good setups for reversals. So we'll keep an eye moving forward if the dollar starts recoupling with the S&P 500 on an inverted relationship basis. You can see the VIX spiking. We have a resistance on the VIX of around 35. There has been some kind of theories out there that, oh, you buy stocks when VIX is above 30 or 35. You sell VIX when it's a 20, or you buy VIX below 20 and you sell VIX above 35. So again, you can kind of use that theory. Again, it's a little more complicated than that, but again, I expect us to get a little bit of a snapback. I think we close the day right around 3,900, 3,923. And the reason I say that is because CPI is tomorrow, and no one knows what the hell's going to happen. So another big unknown event, a binary event. I wouldn't put a lot of risk on the table with that being said. So keep that in the back of your mind that tomorrow is another big report. We have all this bank stuff going on. President Biden speaking right now on the banking industry or banking. Wednesday we have PPI too. So and throw it on top on Friday is an OPEX day, which is options expiry. So I always say that we always have the gauntlet. It's another gauntlet week, and we're gonna make the most of it. So let's make it great Monday. Make it a great trading Monday. Patience, guys. There's no reason to do anything right now. Wait for your marks. Wait for your target. You're a sniper, and you have only a certain amount of ammo. That's your capital. Make sure everything you shoot is either a headshot or pretty damn close. So there's nothing needed. We don't need to spray a bunch of bullets on the screen. Let's just wait, be patient, and see if we get a break either above 39.30 or below 38.30, which would give us an opportunity to short at 3,800. Have a great rest of your morning. I will see you guys tomorrow for the morning note. We'll see you then. Cheers.